Yeah.
Cool. Right, so thank you everyone for joining and welcome to our Tax Saving Strategies for SMEs webinar tailored for business owners and managers. My name's Armand. I'm part of the client success team here at Knorr, and joining me is Tom Francis. He's our head of accounting here at Knorr. Tom, as always, thank you so much for being here and thank you for your time.
Pleasure to be here.
So just about a bit about Knorr. We are an award-winning online practice accountancy agency assisting companies with company secretary practices and the accountancy needs across both Ireland and the UK. We are proud to be recognized for our excellence in providing services, and we believe in offering our clients top-notch solutions for their unique business needs. Our team consists of highly qualified chartered accountants who are member or highly qualified accountants who professionals who are members of the Chartered Accountants Ireland and the Association of Chartered Certified Accountants. Embracing technology is at the core of our operations, and we utilize digital processes to streamline your accountancy tasks, making them more effective and hassle-free for you. So the goal for today's webinar is to make things as engaging and interactive as possible. So we'll keep things conversational, and we'd like to encourage you to submit your questions throughout. The webinar is only 45 minutes and there's quite a bit to get through. So please feel free to put your questions in the Q&A, and if there's anything that we don't get to answering, our contact details will be at the bottom of each slide. I'll share it with you along or at the end of the presentation as well. Just very important to note, the information that we discuss in the webinar is for general information purposes only. If you do have specific advice related to your business, it's always best to consult directly with your accountant. And if you don't have an accountant or you are interested in learning more about our services, please feel free to reach out to us. So in today's webinar, the goal is to help you understand how you can optimize your business setup. We'll learn how to optimize business expenses. We'll explore strategic profit extractions, understand the importance of compliance with your tax regulations, and learn how to harness the power of financial forecasting. So with all of that said, Tom, I'll hand over to you.
Thanks, Armand. Yeah, for the lovely introduction. And quite a mouthful, all those different accountancy bodies. So you did very well to get your head around that. So yeah,
Thank
lots
you.
of qualifications around the place, but yeah, nonetheless, all equally as good. So look, I think normally we start with the strategy around optimum business setup as our first strategy, because I suppose laying the foundations is just the most important part. You might be a new business owner, but you might also be an existing business owner where, you might have set up as a sole trader and, at that point in time, you might have been testing the market, not sure whether this is going to work, testing the idea. And, we'd often see business owners change later to a different structure. So it's equally as important for new business owners as existing business owners. Um, and having the correct business structure really, I suppose, feeds into tax as well. Like you have the right structure, um, optimizing your tax bills. So with that in mind, then the two main structures, I suppose, you're looking at sole trader. It's the very simplest way you can set up in business, little cost and very straightforward. You're just registered as self-employed with revenue, registered for income tax or activating your income tax head with revenue. And you might be registering a business name with the CRO. With sole traders, unlimited liability jumps to top of mind, meaning I suppose your personal assets could be at risk if anything untoward happens in the business. Business incurs debts, for example. Your personal assets could be at risk. So it could be your home or whatever. Business owners tend to be taxed on the business profits. So if the profit for the year is €10,000, you're taxed you're taxed on all the profit, regardless of what you take out yourself. I suppose you're just taxed on everything, and tax rates can exceed 50% or more, depending on the numbers. Companies, on the other hand, they're separate legal entities, so that means that they're independent of the owners. They offer limited liability protection to its owners. So again, I suppose the opposite of the sole traders then means your personal assets are generally protected, If anything untoward happens in the business incurs debts. Companies are taxed at 12.5% corporation tax rate. And that beats obviously the higher income tax rates, which can be 50% plus. With our clients, we find that a lot of the reason they set up as a company would be to give them more credibility and stability, potentially making it easier to attract inward investment, be that from a bank or be that from, other grants from, the likes of Enterprise Ireland or the local enterprise office, or also to secure new business deals with customers or suppliers. So there's no kind of one reason they tend to just decide on a company, just, I suppose, depending on the circumstances. What I would say with companies is setting up and running a company, there's a lot of what they call red tape, compliance requirements. So you have to be very compliant when you have a company. You have to submit a corporation tax return to revenue. So it's a tax return, company tax return. You also have to submit an annual return to the company registration office. And then for yourself personally, the director, then you have to submit an income tax return to revenue every year. Sole traders, it's just an income tax return every year. So there's a little bit more involved with companies, but I suppose you have to weigh the upsides with the downsides. We often get asked, Armand, what should I do? And no doubt you do too. What should I do? There's no black and white answer. There's no rule book to say, you follow this procedure. It really just depends on personal circumstances and I suppose what your goals are. So, for example, if you plan to reinvest your profits and grow the business, generally speaking, a company tends to be a good way to go, because you can just pay 12.5% tax on your profits and not be taxed on everything up front as you would be with a sole trader. You can grow the cash pile within the company and then do other things with the money, which we'll come to later. If your business involves risk, forming a company, kind of a no-brainer. It can protect your personal assets like your home. But as I said, ultimately the decision should really be based on your specific needs, your goals, and the level of risk you're willing to take. And as I said at the start, some business owners do change structures midstream, and that's okay. That's fine, because you might pivot in a different direction, or you might get involved with another. It might be a couple of shareholders as opposed to just yourself, and you need to have the legality set up there, and that's okay. It can all be done. But I suppose overall, my advice would be, talk to an accountant or someone who's familiar with tax, and they can kind of give you the right steer. Once your business is set up, then you definitely need to make sure that you get the taxes all set up. You're registered for the right taxes, whether it's income tax for sole trader or director, corporation tax, things like VAT, PAYE, registering as an employer. So there's a whole suite of taxes you might need to register for. And again, you mightn't be sure. That's okay. Your accountant will be able to guide you in a direction. And then, as I always say, like equally as important with setting up, you might set up your structure, register for taxes, set up your bookkeeping system. Then is really important. So having a good and right bookkeeping system in place makes life much easier for yourself as a business owner, because you have numbers, reasonably regular numbers, which you can make decisions off, and also with a good bookkeeping system, your accountant could have access in there as well, which is actually much easier. So clear records is key then with bookkeeping. So we cover all that as we work through the webinar today. But Armand, I think that feeds it nicely into our next section then.
Absolutely. Just one takeaway for myself and possibly for some of the participants would be just highlighting something you mentioned there, which is having a sole trade and then transitioning to a limited company. That is, of course, possible. That is something that I have seen a bit more of. And definitely, if that is something that you're looking to engage in, like Tom said, do speak to your accountant, or feel free to reach out to us if you don't have one and you have that scenario, or you look to decide which one of the two would be more suitable for you. But on to the next one then, Tom. I'm going to go to the next one, which is optimizing business expenses.
Indeed, yeah. So optimizing business expenses, we keep that as our second strategy, because really and truly, most of the time in business, to save tax, you just need to claim every allowable business expense possible. I suppose there's two factors that feed into profit. It's your sales less your costs. Your sales pretty much, they are what they are. Your sales invoices, or your cash, your receipt logs if you're in retail, whatever that might be. But your income is your income. Your expenses are your expenses, but I suppose it's almost been cutthroat with your expenses. And yeah, you want to minimize your expenses so you can make some profit, but also if you incur an expense, you want to be able to claim it as a tax write-off as well. So that's why it's a second strategy. And really, to do this really well, you have to keep good accounting records. My view is that you need an online accounting software as part of your bookkeeping system. And I alluded to it earlier, a system both yourself and your accountant can log into simultaneously. It could be yourself, your accountant, and your bookkeeper. It just depends, who's involved in the bookkeeping process with you. But certainly, an online book accounting software now is the norm, and it works very well. Definitely Sage or Xero, very good offerings at the moment. So when you have a software then set up, you need to record, as I said, your sales invoices to your customers, your purchases from your suppliers. So what ultimately what I'm selling and what I'm buying. Onto the software then as well, you have to log your bank account. So your company bank account, or your sole trader bank account, your business bank account in summary. So the receipts coming in and the payments going out from your bank, and credit card if you have one. So you get the full picture. You have your invoicing on one side, which is your sales and your purchases, but on the far side, then you have your receipts from your customers and your payments out for your purchases. So what I really like, Armand, with the kind of the modern accounting softwares is that you can keep a copy of your documents on the software now, which is even better. You don't need the filing cabinet. That day is gone. You can just, like with Xero, for example, you can upload a copy of the purchase invoice or the receipt against the transaction. So there's nobody going to be asking you for copies. Like, for example, if your accountant is working on your accounts or your bookkeeping, they're not going to be asking you for copies anymore because it's already in the software. And so it's really good. And Irish Revenue are very happy to work on that basis as well, where the invoice or the whatever is linked into the transaction. But what I always say is it's really important to keep good evidence of your expenses, because I suppose traditionally, to claim an expense, you have to have a piece of paper. Now it'll be like a soft piece of paper as opposed to a hard piece of paper, but it's that purchase invoice or that receipt. Because I suppose often it'll be educating new business owners around that. A transaction in your bank doesn't allow you to claim that expense. It just proves you paid somebody for something. It doesn't actually prove there's an expense claimable. What proves there's an expense claimable in many cases is the actual purchase invoice or the receipt. In terms of what expenses I can claim, there really is no exhaustive list. The sky's the limit, I suppose, depending on your business. So I would normally ask the question. So somebody asked me, what expenses can I claim? I'd normally ask the question, would I have incurred this expense if it were not for the running of my business? So would I have incurred the expense if it were not for the running of my business? The answer to that question is pretty clear, because if it's a no, I would not have incurred the expense if I were not in business. Then in all likelihood, it's a valid business expense. It needs to be as simple as that. And if you can start there, you're kind of off. Like you might be down in the coffee shop buying a coffee. But why am I buying the coffee? Because I'm here to meet somebody, or or why am I incurring this mileage expense because I'm going to the bank? Why am I going to the bank to arrange? So it goes on and on. So in most cases, the main allowable business expenses, a lot of it would be very obvious. I'm buying materials, I'm buying supplies, for resale, or I'm buying equipment, I have insurance, I have telephone, internet, light and heat, all that kind of stuff. Advertising, big one, obviously Google or whatever medium you potentially choose for advertising. wages and salaries, whether it's a director's costs or whether it's employees' costs, they're all allowable expenses. And if there's business loans, interest payable on the loans. And then indeed any other costs associated with running of the business. So as I said, I suppose my job here isn't to go through every single cost. It's to encourage you to ask the question, would I have incurred that expense if I wasn't in business, and so on and so forth. So that's generally it. So if I suppose just we touched on mileage a little bit earlier. Look, if you own a private motor car that's used for business, that you might use for business trips, you could potentially claim some mileage there on those business trips. So that the company or the sole trade doesn't need to own the vehicle for you to claim some mileage. Just to be aware of that. But then there's a whole, you have to have mileage logs, etc., etc. But that's, I suppose at this point it's just an awareness, Armand, of what's possible.
Yeah, absolutely. And
Yeah.
it like you've been saying, and like the theme has been going, it's best to speak to your accountant about your unique needs because they do differ and each case is different. But it's interesting you touched base on the physical copies in your cabinets. I've got a question from Sarah in connection to that. Does Revenue accept PDF electronic versions of our receipts, or do they keep do you need to keep your hard copies?
No, and we recently actually, I suppose to prove the point, we had a client at an on-site visit from Revenue there a few weeks ago, and they're happy to work with the PDFs. So what happened in that case was they just asked us to upload the PDFs to their portal, and then they review, etc. So there's no question at this point. It's not even a question, where the originals. It's just send us the PDFs and we'll review them. Any questions, we'll come back to you. So there's no need to be keeping hard copies anymore. And think about the online softwares now, like that have automatic bank feeds as well, Armand. Like literally, the bank account talks to the software. It feeds in all the transactions in there. You don't even need to really have to worry about bank statements anymore. Yeah, you might need a year-end bank statement for your accountant, but generally speaking, day to day, you don't need that necessarily anymore. So it's really all gone electronic / soft copy now at the moment.
It actually makes things so much easier.
Oh yeah,
Definitely.
yeah.
I know, but thank you, Sarah, for the question. I'm going to then move on. If anyone has any questions, please feel free to put it either in the webinar chat or in the Q&A. We'll be happy to answer those. So now the business has been operating and it's time for me to perhaps extract some form of profit. How would I go about in that, Tom?
Yeah, and it's a good problem to have because in the early days in a business, it's not even a conversation on the table. The business owner often puts money in, and so on and so forth. Um, Maybe a couple of years on, there's some certainty there, and you can start to look at extraction. And actually, probably where we should start is if a business owner does put money in, actually, you can, so let's say I set up a limited company um, a year ago, and I put 10,000 euro into the company bank account of my own personal funds, just to get the company up and running. There was no particular, need for the 10,000 at the time. Like it wasn't directed for any particular expense, just to give it cash flow. So a year on, 18 months on, there's a bit of money now building up in the business account. I can pay myself back now. I can pay myself back 10,000 euro one lump sum, or 1,000 a month, whatever I decide. Director's loan repayment. So it's just if you are doing that, 10,000 goes in, director's loan, 10,000 comes back out in one lump or in a number of payments, director's loan repayment, tax free. I suppose that's why I want to make sure we're on it. So it's not wages. So we want to make sure nobody gets confused on the accounting side or the payroll provider side. Like it doesn't need to be returned there. It's just a pure money in, money out. Um, Look, outside of that, then you want to pay yourself a salary. You might want a pension. So we'll talk a little bit about that now as well. And they're generally the two main options for payment is salary and pensions. But salary is just it's a fixed payment, whether it's monthly or every 2 weeks or whatever you decide, paid to the director. Now, interestingly, like a shareholder, we talked about shareholders a little bit this morning and directors. A director can be a shareholder, right? A director can be a shareholder because I could own my company, so I'm a director by default, and I'm also a shareholder. But a shareholder doesn't necessarily need to be, they wouldn't necessarily be a director. So because they might just own the shares, might just be shareholders, but just just aren't in charge of running the company. So a shareholder can't take a salary without also being an employee. Just an FYI at this point, shareholders might take a dividend or some other way of payment. So day-to-day business owner will want some salary to pay their day-to-day living costs. So whatever the company can afford, go ahead, go do that. I suppose there's no limits as such. It's just whatever the company can afford. Outside of that, then I'd always encourage a business owner to take pension, plan for retirement, even at a miniature level. Even if literally it's the last thing you want to be doing. It could just be paying in €100 a month or €200 a month into a pension. It's a great idea, just to kind of get the habit started. Later on, if things go well, you can ramp it up, etc. But pension really is probably the most efficient way of paying yourself as a company director. And for business owners, what makes it really efficient is that any contributions the company makes on behalf of the director, they're tax deductible, firstly, right? They're an expense, but with no payroll taxes for the director. So there's no payroll taxes, no benefit in kind. You're literally getting money from the company into your pension, tax free. So it is really good. And I suppose at a high level, I'd encourage a mixture of salaries and dividends. So sorry, salary and pensions, because you want the salary for the day to day. The pension, you won't get it till retirement age. But you're planning for that. That probably is the catch with pensions, is that you can't get your hands on it now. You have to wait. But the tax free element is really attractive, because for regular employees, if they make a contribution, it comes off their wages. Yeah, they get tax relief, all right, but it comes off their net wages at the end of the month. So with company owners, that's not the case. The catch with pensions is you have to pay the pension in the financial year. So let's say my year end is 31 December 2025. I've just set up in January. My year end is 31 December. You have to actually make the physical payment over to the pension provider in the financial year to get the tax write-off. That's really the catch. So and so depending on what your year end is, and you think that might be profits there, you want to just shelter a little bit, you could talk to your accountant, and with a view to getting some of that paid over before the year end. It doesn't have to be huge money, but just to I suppose every little helps, I would say. So a combination of both works really well. And Armand, I think outside of that, then you're looking at other means. So things I've seen and advised clients to do over the years. Number one, if you're a shareholder, selling shares can be a really good way to extract value. So capital gains tax rates in Ireland are 33%. There's other lower rates of CGT as well for the entrepreneur relief as well. Like that could be as low as 10%. So if you compare like 33% with income tax rates of 50% plus, if you're looking to extract value, potentially selling shares could be a good way to extract value, assuming it makes sense to do that. Outside of that, selling personal assets to your company, it's often it's a really popular one. So for example, like you might own a warehouse personally worth €200,000, which is the price you bought it for. Maybe you bought it a year ago or less, and it cost 200. That's pretty much what it's worth now. And the company has some cash on the balance sheet, so the company could potentially buy it off you at market value. So all these transactions have to be at market value. And you can extract 200K from the company with no personal income tax or capital gains tax, because you're buying it for what you sold it for, and the company then the company puts the warehouse onto its balance sheet. And the reason I suppose property kind of makes sense sometimes is because you and it goes back to where we started, by the way. Where we started this morning was company structure, because having a company and if it's building up some cash on the balance sheet, you mightn't necessarily want to take it out in terms of salary or dividends, but you might want to do something else. You might want the company to invest in property, and it mightn't be in a personal might be in a warehouse that you own personally. It might be just another asset, property. Often what we see some business owners do will be to have a trade co, which is where the normal trade happens, but also have a property company as well as another arm of. So you're kind of setting up a little group structure. So the property company sits kind of separate from the trading company, um, and each are doing their own thing. They can move money over and back from each other to each other from each other, assuming the right structures are in place. So it does tend to work well. So property, whether you're selling an asset to your company or investing in property, can be a good move strategically in terms of using company funds. So I suppose outside of that, we talked about the loan. So you could loan your company money. We talked at the start, but you could also take a loan from your company as well, like a really short-term loan. Let's say you needed short-term loan. Maybe you're buying a house and you needed some short-term loan for deposit or whatever it might be. Um, what what can be done is business owner company owner director borrows money from the company on the 1st of January, to borrow €5,000, pay it back before the end of the year. You've got an interest-free loan, but you have to pay it back, otherwise there's complications. Um, so there can be short-term loan there. It doesn't necessarily save tax per se, but it certainly can help with cash flow if you need it. Um, on the other side, then sometimes a business decides to close for whatever reason. It could be maybe trading conditions dictate it needs to close, or decisions made to close it, maybe for whatever reason. Liquidation is also a good way to get some value out of the business at capital gains tax rates as opposed to income tax rates. The capital gains tax rate is 33%. So we're only touching things, Armand, lightly on things this morning, this afternoon, but there's multiple avenues there for playing with a little bit, and all just playing on the tax rules and tax laws and all that. So if you're working with an accountant, I suppose having them kind of truly understand, I suppose, your goals, what you want to achieve, what you see as important, will all play into kind of what way you go. So I suppose with that in mind, then I suppose I'll hand back to you, Armand, and let you go from there.
Just before I do go to our next section, Tom, like
Mm.
you said, there's a few options available for you to extract profits, and your accountant would know best for your specific business need. But I've got a question on more specifically on the business expenses that we discussed a bit earlier, and more in particular, a company car. Is it a good way to spend company money for tax purposes?
It can be, yeah. It can be. They say, this is the rule of thumb. They say that if you're buying a new car, or newish car, company purchasing the vehicle can make sense, because I suppose, um, when you think about it, newish car, there's going to be obviously kind of high value, no matter what way you look at it. It's going to be high value, um, and there's going to be loan repayments and all the usual running costs as well. Um, So if you were to cover that personally, I suppose, yeah, like versus the charge to benefit in kind, which is benefit in kind. If your company provides a vehicle for you, generally there's a benefit in kind of some sort. So you're kind of taxed on the benefit you receive. Benefits you tend to receive are things like, well, you don't suffer personal depreciation on the vehicle. Like if the vehicle goes down in value, the company suffers that. You don't have to pay the tax and insurance, you don't have to pay the loan, and so on and so forth. Um, but however, on the other hand, then, Armand, if you're purchasing an older vehicle, I mean, let's say just for argument's sake, a 10-year-old vehicle, or um, they say that if you run the numbers, claiming mileage from your company by driving an older vehicle, so you own the older vehicle personally, you're just doing business trips in the older vehicle. It's more beneficial actually to drive the older vehicle, own it personally, and claim mileage from your company. So I suppose Depend. So to the question that was asked, then it is potentially a good way. And we see business owners do it both ways, by the way. But on the newer vehicle, it tends to be make more sense to go down the company buying, you know, and the older vehicle buy it yourself, claim from the company. And when you're claiming mileage from your company, it's tax free, assuming you complete the mileage sheets and all that. There's a bit of background prep that goes into that, but
Mm.
you're getting money out of the company tax free. And if you have a 10-year-old vehicle, the chances are you might have a small loan or no loan on the vehicle. So it's all cash positive for you personally.
So either one has its benefits. No, thank you for that question, and thank you for the answer there, Tom. We've discussed the expenses and the extractions. Let's move on to the compliance regulations, if that's all right.
Sure, yeah. Yeah, compliance with regulations. This is kind of the boring part a little bit. Yeah, no. Yeah. As a business owner, you set up with a view to looking up at the sky and jumping for as high as you can. You have to bear in mind then the importance of keeping compliant with the laws and regulations set out by both Revenue and the company's registration office in Ireland. And we talked earlier. We talked about filing two returns a year at a minimum. That's the basic. Like you might be registered for VAT. You have to file a return every 2 months. You might be registered for as an employer, monthly return to be filed. So it can soon gather pace with the amount of returns. So what I would say is make sure whatever returns you have to do. Firstly, make sure you register for the right taxes. That's key. And then once that's been done, then make sure that you're doing all in your power to make sure you can file your returns on time. Often business owners don't have the time to devote to that, and that makes sense. Like you want to run your business, your value is in running your business. Um, so if you find that you don't have time or you're out of your depth, that's okay. Like I would say, just get a good accountant to do it for you. Lets you focus on the day job. Lets you focus on running the business, adding value. Working to your strengths. But whatever you do, make sure your company is compliant and have the right people involved. That's probably it in a nutshell, Armand.
Mm, absolutely.
Hmm.
And the contact details for Knorr is in each of the slides, but I've shared it here in our group chat for the participants as well. Please feel free to reach out to us if you've got any questions at any time. But we are moving toward the tail end of the of the webinar, and I'm just moving on to the financial forecasting section then, Tom.
Yes, knowing your numbers is really important, and that's why we keep that one as a theme. Um, Cash flow is really important when running your business, and often business owners will just look at the bank account, as a gauge of how things are going, and that makes sense. I mean, your business can't run if there's no money in the bank. A question we get asked quite often, and particularly when we're kind of preparing month-end management accounts or year-end accounts, you know, might be coming back to at month end, they might be coming back to a loss or a very small profit when there could be a whole heap of money in the bank account. So we often get asked the question like, what's the difference between profit and cash? So I'll start by explaining what each one is. The profit is the amount of money the business earns after take account of income, which is like your sales invoices, for example, less your expenses, your purchase invoices, your receipts, that kind of thing, payroll. So it's what's left over after all the costs have been paid. Cash then is actual money that the business has in its bank account. It's physical cash. And I suppose the main difference then is that profit is a measure of the financial performance of the business, whereas cash is money in the bank, measure of the company's ability to pay its bills in the short term. So um, what what's always interesting is you can be profitable but have little or no cash, or you can have cash, plenty of cash and not be profitable. Um, so it's understanding the difference between the two is what's really important. Um, and I suppose the reason for that, the reason you can be profitable have no cash, is because you might have raised tons of sales invoices to your customers. They haven't paid you. and that's just in its simplest form. So I suppose when we're looking at knowing your numbers, um, yeah, we can talk a little bit about budget and forecasting, and things we see in that area, mistakes we see business owners make or things that could be done better. Because a lot of yeah, business owners, it's not a rule of thumb that every business owner budgets or forecasts. It just isn't, and that's why I suppose the most important thing a business owner could do is even have a basic budget or forecast. Because like with budgeting, you're budgeting what your sales will be for the next 12 months, let's say, and what your associated costs will be, whether that's wages, whether that's materials, and other overheads you might have. So the best thing a business could do is even have a basic budget slash forecast. Now, the budget looks at the kind of the invoicing side and like the sales invoices every month and the purchase invoices and all that wages. Whereas with the kind of the cash flow forecast, and then it's the money. It's forecasting the flows of the money. Like, so I've raised an invoice, sales invoice in January to my customer. They have terms of 60 days. So I'm expecting to get paid, end of February. So I'm budgeting that in my cash flow forecasting, because what you want to do ultimately is kind of find the pinch points, or where you think the pinch points will be during the year. So what I would say is a budget or forecast is only ever as good as assumptions that can go into it. So for example, as I said, you might be assuming that your customers will pay in 2 months. Is that reality, or is that just what you write in your invoice? What's the reality? Is it 3 months or is it 4 months? Because often it is. And what you're expecting your sales growth to be every month, every year. So there's a whole lot of assumptions that go in. And the assumptions that go in have to be solid or reasonably solid. It won't be perfect. There's nothing perfect, and don't try for perfection, because you'll never start if you're waiting for perfection. So start basic. Um, so yes. So I suppose just around the assumptions, then with the income, business owners might overestimate what the sales will be, and the timing of when the business will receive payment from customers into their bank accounts. So then you're therefore overestimating cash inflows. And if your cash outflows are based on your inflows, then you could be overplaying your cash outflows then. So managing expenses is so important when it comes to cash flow, because companies that overspend or have large expenses due at the same time, you'll find yourself then suddenly you have negative cash flow. Your bank account could be out of money, even to a lot of sales invoices raised, etc. It's just timing. Timing is the key. So I suppose have a kind of an equal emphasis on cash flow and profit. As we said, many business owners tend to focus on cash flow as a measure of performance, and it's absolutely right to do that. But is the business actually generating profit at the end of the month or at the end of the year? That's you gotta keep one eye on that. Um, Also really important with numbers is having that cash reserve then. So like you need to try and keep some cash in reserve in case you're caught off guard by an unexpected expense. It could be a machine breaking down, or it could be the fact that you need to take on a new employee to cope with the demand, um, or there could be a downturn in the economy, or you don't know what it might be, but having a little cash reserve would be key. So like I think with companies, I think they allow you to build up the cash reserve, which is great. So you could have enough money then to weather any challenge that you might have. So pay close attention on cash flow. Have reasonably strong assumptions going into your budgets or forecasts. And I suppose, Armand, like a lot of business owners kind of figure it out as they go, but often I would often say to clients, what got you here won't necessarily get you there. So you might have got through your first couple of years of trading, but when things start to get kind of big and more interesting, you do need to pay a much closer attention to the numbers, as painful sometimes as it can be, because I always say that the numbers just don't lie. Like the numbers will tell. the real story, ultimately,
Yeah, you have to keep an eye on those resources, and that's great advice, Tom. Thank you for sharing that. We do move on now to just your final thoughts or your top tips then.
Yeah, I suppose that, I mean, we've been talking a lot about business expenses this afternoon. So business expenses is probably key. Like you literally claim as many business expenses, as you can. So, you know, keep the evidence allowing you to make that claim. So even if you're not sure, keep the document, and all that sort of stuff. So allow you to claim the expenses. Company car. The question was even asked actually during the webinar, like should I have a car or should I not? So keep that on the radar, because I think it was a really good question. Ask your accountant, what makes the most sense. They'll do a calculation of you doing it one way versus the other, and see which is the best net impact for yourself. And then the last point, then I suppose profit versus cash, like knowing the difference, is so important.
Definitely. And with that, we have come to the end of our webinar. If you've enjoyed today's webinar, or as a client of Knorr, you'd like to share your experience with others, please feel free to do so in the link that I've sent in the webinar chat. If at any stage you have any queries, please feel free to reach out to us on our contact number, or email, or our website. We really want to thank everyone for taking the time to join us today on the tax planning webinar. We hope you found the information insightful as you navigate through your tax strategies for the upcoming year. Just again to reiterate, it is highly individualized, the tax process. So what works for one might not work for another. And that's why we keep on saying, if you have an accountant, do ask for their professional advice. If you don't have an accountant and you're interested in learning more, again, please feel free to reach out to us. But with that said, I'd like to thank everyone for joining. And Tom, thank you so much for the time and for all your insights.
Thank you.